Attendees are in listen-only mode.
Good afternoon, everybody. This is Stan and Jack, and we're here to do a webinar today on trading the markets using timing cycles. So, price action is very important, but also placing price in time is important. And we're going to be spending this webinar basically looking at three different tools, three different techniques for placing price in time. There's a questions tab. If you have questions, of course, ask questions during the webinar. That's what the questions tab is there for. Our disclaimer. Let me just pull up the disclaimer here. What we're doing here on the Art of Chart is we're doing what we're doing for educational purposes only. We are not issuing trading signals in this webinar. We're here to discuss technical analysis and showing you what good setups look like using, in this case, timing cycles. And we combine then timing cycles with other tools like Fibonacci's and classical analysis, which really helps us, get a better feel for, more profitable setups. I think that's kind of the point. So with that said, Jack, anything you want to add?
Nope. Let's go.
Okay. Let me start by introducing the whole concept of timing cycles, okay? Now, I have a chart of the S&P 500, and there are many different techniques and tools that you can use to look at timing cycles. So this is a daily chart. And I'm going to show you a number of different techniques. I'm going to start with the simplest first, which is what I call a price using a pitchfork, actually predicting time using a pitchfork, okay? Very simple technique. I think some of you have actually seen me do this. You just take your typical pitchfork diagram. You take a high, you spec out a move like this where you have a 3 back. You have to have a 3 back like this in order for this technique to work. Okay, let me just edit this and make this really thick so everybody can see it. Okay, so there's your pitchfork. Okay, very often in a pitchfork, one thing that happens is you penetrate the midline, and that is a support area, or typically in a pitchfork you will come all the way to the bottom. Okay, and there's a way of actually looking at timing here to actually try to predict. Okay, so if this is a pitchfork and if we have a 3 back in a pitchfork, this is the requirement, you have to have a 3 back, and there's a requirement here too in terms of there being an inside day right here. Okay, but bottom line is this: if you have a pitchfork setup like this, and you have this high, if we were at B or maybe just mildly past B, you could draw the pitchfork, and what you could do is this: you could use what I call the box method. Box method is very simple, and you don't even need to draw a pitchfork for it, by the way. You could just do it like this. Box method, that's an amount of time. We drag the box over to here, and look what it does for us. It actually tells us where to expect a turn here in the pitchfork. So we would expect a turn in the pitchfork either here at this line at the end of the box, at the midline, or at the bottom of the pitchfork. Okay, so what this really denotes is that at the midline here, if we pass this marker, basically that the next move is out of the pitchfork. Okay, so that's how the pitchfork technique works. You can combine this with other tools, like, for example, look right here, you can see RSI divergence here. Even though we didn't make a new low, you could surmise that momentum to the downside here is waning, etc. So that's a very simple tool. And by the way, you can use pitchfork without using you can use the box method without using a pitchfork. Like, for example, very often you get symmetrical moves. Okay, so symmetry is something that you see in the market. If you really look for it and pay attention, you'll see it. Okay, so symmetry, for example, using the box method, this move here, the high to low swing from here, let me just try to get the box working here. The high to low move from here to here. And why is it not working? Strange. Let's try it again. Okay, we have the box on. Let's do this again. From here to here, that swing, high to low swing, if we look at that and we drag this over, you can see that very often this high to low swing is matched in some way in symmetry in time to the very next move. Okay, so you can actually, some people, what they do is they take their charts and they will block them out in periods of time like that, and then another one like this, and then another one like this, and they'll just block it out in sequences of time. And that's another technique that's similar to the box method, if you will, but I like the box method because it's you know, what we're looking at here is an A equals C move, an A, B, and then followed by a C. So very often your A leg is often linked in time to your C leg. Not always, but often, okay? So the box method is very simple. All it is high to low swings, okay? That's all you're measuring is high to low swings. You can also measure high to high swings using the box method as well. And so, you know, if you were doing a high to high swing, for example, let's just do one here as an example, and I'm not even sure if this one's going to work, but you know, here's a high to high swing from your high there to your high here. Does that match in any way, shape, or form the next high to high swing? Well, look at that. It does. Okay. By the way, not exactly to the bar, but within 2 bars. Okay, and that's actually pretty good. Okay. Now you would ask the question, I wonder if the next high to high swing is going to match. Okay, do we have the possibility of the next high happening in October? And I don't think we do, by the way, but because I have a high window coming up here shortly on Hurst cycles, which I'll show you shortly. So all I'm trying to demonstrate to you is that, you know, time in the market is important, and time is actually more important in currencies, in my experience, than they are in any other instruments. So the box method and timing in currencies, it pays big. I think timing in the indexes, it's a more difficult task, but it does work. Okay. So with that said, let me first of all see if there are any questions on the box method and using pitchforks. Again, you can use this on any time scale. Okay, on any time scale, and it's a very, very useful technique, and it's something that that I use a lot in the work that I do. Now, I don't leave pitchforks typically on my charts. I usually mark my charts with high and low windows. So, any questions so far? If not, I'm going to introduce. And let me go to a currency chart because I think currencies are a big deal when it comes to cycles. Because currencies run in cycles. There's certainly no question about that. If you look at the bigger picture of certain currencies, they are cyclical in nature, and also there's a bigger picture sort of cyclical nature to. Let's see if I have the pound weekly. I don't think I have the pound in a quarterly, do I? I wonder where that went to. Okay, currencies basically, when you look at them on a very, very long-term basis. Okay, and I'm not going to be able to do this because I don't have my monthly pound chart. I'm wondering where that went to. Let's see if I have it on the euro. Okay, I have it here on the euro. If you look at monthly charts on currencies, okay, and you look at cycle brackets, all this is a cycle bracket, a low swing to high swing on a cycle bracket. Okay, so low swing to high swing, a 3-wave move, an A, B, C. You can interpret it 3 waves here or 3 waves here. This could be an A, B, and a flat, whatever. So the Y could be here or the Y could be here. It doesn't really matter. But the bottom line is, here's a high to high swing that's matched by a high to low swing that's matched by a low to high swing. Okay, that's matched by a high to low swing. So we're looking at a time period here. And when is this time? Hold on, let me see. It's roughly speaking it's roughly speaking this month. Okay, so in the August-September time period, that's where this bar comes in. Now you can see the bars on a monthly period are not exactly. It is here exactly on the right level. Here it's not exactly on the right level. It's off by 2 bars or 3 bars. So you can be off a bar or 2. Okay, but typically currencies on a monthly basis. On the big swings in currencies, you will see cycles, okay, and these are nothing but cycle brackets, okay. So you can go to any TA program you want. You'll see cycle brackets on a long-term basis, and by the way, take some practice and some skill to do this. You can use cycle brackets this way, and then you can actually break them down further, okay. So you could take your cycle bracket tool. And let me see if I have my cycle bracket tool handy here. I probably don't, but I'm not going to do a real-time live cycle bracket piece of work here. I'm going to spend my time doing Fibonacci's in a moment. But this is another technique, and I do this on currencies. Bigger picture, longer term currencies. So like, for example, my pound monthly chart, which I can't seem to find right now, I have a low for the pound in December. Okay, and you know, we were looking at in the pound, we were looking, let me pull up a pound chart here. You know, we just had this very large decline. We were looking at 34s forever. I'm still looking at a low window here. We're still in a low time window. I'll show you where that comes in a moment. But the bottom line is this. With timing cycles, what you want to do is you want to pay attention to the large timing cycles, like on a monthly basis like this. Okay, you can then on a shorter term basis use pitchforks. Okay, but then you want to even add to it further and enhance your work by paying attention to what I do, which is Hurst cycles. Okay, now let me try to explain what a Hurst cycle is. This is bonds, by the way. Okay, and I'll go to the bonds chart in a moment. Bonds play out very, very well with timing. Okay, so bonds right now, we are in a low window in bonds. Okay, and we are expecting a back test once we exit this low window, and the back test will go up into, roughly speaking, the beginning of September, and then we're expecting a major move lower in bonds, looking at the cycles. So cycles work this way. Okay, that's a 40-day cycle. That's a 40-day trading cycle in Hurst analysis. Now, what Hurst analysis does, as you can see, we have a pink cycle here, a purple cycle, a blue cycle, a light blue cycle. And if I scale in a little bit, let me scale in a little bit here. Okay, there are cycles even deeper inside of this. Okay, there are cycles that go down to 5-day and 10-day cycles. But what I typically do on Hurst is I'm looking at a 40-day window. Okay, 40-day window, we're looking at a low. Look at the cycles stacking up here. We have the 5-day cycle, the 10-day cycle, the 20-day cycle, the 40-day cycle, and the 80-day cycle all lining up. When you get 4 or 5 cycles lining up like that, or even here, you can see these 6 cycles here, you know, that stacks up for a low. Okay, and this is what I look for. I look for multiple cycles in terms of how they stack up. So this is stacking up for a low, and I'm expecting a 40-day high window in bonds. This is TLT, by the way, and that's coming in roughly at the beginning of September. Now, I want you to notice there's a window here, okay? And by the way, nothing in trading is 100%, and nothing in trading is perfectly accurate, ever, okay? This is just one tool that I use, and I correlate it with other tools, okay? So the beginning of this window is the 29th of October, and the end of this window is roughly the 8th, okay? That's a pretty decent period, okay? And so for me, I'm going to be, I still think we have a little bit more downside in bonds coming, okay? And I'll show you the bonds chart in a moment, but when I have a 40-day window like this, and it stacks up, by the way, with a 20-day window, you can see there's the 20, and there's the 10-day window. Oh, and by the way, it stacks up with the 80-day window, and look where the 80-day window ends up here, okay? So I have multiple cycles telling me that we're about to get a bounce in bonds, okay? Now, we're not really ready completely yet, because the end of this window, this low window in bonds, is the 22nd of this month. Okay, and by the way, that correlates with the indexes because I'm looking for a high in indexes roughly in the same time period. Okay, so so this is how I use Hurst. Okay, I look at my charts, I look at my fibs, I look at my typical analysis, and then I look at Hurst. I look at where the low windows are and the high windows are. Now, let me show you an example of how this plays out in bonds. In a real example, let's go to ZB as an example, okay? And if you folks have questions along the way, because I'm just walking through what I do here, if you have a question, ask. Okay, so here we are, and we have 100% fib up here at 177.23. And here was the high window, have it clearly marked, okay? And by the way, here's that low window that we just saw in bonds, and you can see we still have time for it to play out, okay? The high window, we were here, and if you remember, Jack, we were talking about this high window, and it correlates because we have 100% fib right here, okay? Look at the 3-wave move up, okay? So it correlated in a 3-up. It correlated in terms of a WX, YX, Z. It correlated based on a long-term trend line that came right up into this area, okay? So I'm not trading based on time alone, okay? But when I have a high window and it correlates with a trend line, with 100% fib, with a 5-wave count, guys, that gives me a lot of confidence that this is a significant turn in bonds. Okay, so this is how we use cycles. This is how Jack and I use cycles when we do our technical analysis. Okay, now I want to say this: cycles are not God's gift to trading. Okay, cycles, there are problems with cycles. Hurst cycles, there's a high window and there's a low window. Now, does the low window guarantee that it will be a lower low? And the answer is no. It is not guaranteed to be a lower low. Like, for example, here we are correcting in a little triangle. We've talked about this on our service. This is a triangle. Let me try to get a trend line going here. You can see the triangle here, the compression. I'll draw it here so everybody's clear about it. Okay. There's the triangle that's setting up an A, B, C. Finished, it turned as we predicted. We're looking for a D and an E. That would be your X wave. And then we're looking for additional downside. Now, that's based on the monthly pivot. We break the monthly pivot, of course, we're going to see higher prices. But we're looking for this X to play out lower at this moment in time. But you can see what happened with the low window here. The low window, we have not gotten a move down into the 100% fib because it doesn't always work. Nothing in trading is 100%. And so here's a low window. We're not, like here's a high window. We hit the 100% fib. It was perfect. It's right smack dab in the center of the high window. And, you know, it's just like anything else in trading. It's a probability. This had a 70% chance. I'm sorry.
Trend line, yeah, the sell signal, you know, it was nice.
Yeah, it was nice. And so this is a 70, 80% probability trade where you put something on and you say, hey, I got a 70, 80% chance, right? Now here's a low window, and given what I see here, do I have a 70, 80% chance that this is the low right here? I don't think so, okay? So this is more squirrely than this. And so what you do with cycles is you try to look at time and price and how they line up together. So, you know, in this case, we're correcting in time in a triangle. That's how it appears to us at this moment in time. So that's an introduction to Hurst, a very, very basic introduction to Hurst. Okay, so there's a low window and there's a high window coming, and we'll see what happens with this. You can see where we are with this green cycle. Okay, the green cycle is the 40-week cycle in bonds, and we have a significant low window coming in the October period. Okay, so all I'm going to say to you is bonds in October, early October, we're likely going to have a significant low. Okay, so I've been talking for the last 20 minutes here, Jack. Anything you want to add, or?
Yeah, I want to actually. I'll just punch it up. I was talking in the last chart chat, and I think I'll just I'll pull up the chart and throw it over to me. Because I'll just demonstrate one way in which, I mean, it's one tool in the box, and there are a number of tools in the box. But hang on 1 second, I'll just pull up my main gold charts. Right, hang on. Now, one way in which cycles are very useful is when you have two scenarios that you're looking at, and both of them look pretty good. And it can allow you to choose which one is the higher probability option. And actually, a very good example is on gold right now. And hang on, just wait for the chart to load. Right. Right, I got the... Right, okay, it's shown on here. We've got two scenarios here of bottoming patterns, both of them inverted head and shoulder patterns on gold. We've got an inverted head and shoulder pattern here. That's the left shoulder, that's the head, that's the right shoulder, a bit undersized, but perfectly valid. It's broken up and it's come back and it's retested the break and done a perfect bounce at the moment. That's got a target in the 1570 area. That's a pretty good match with the 61.8% fib retrace, and that is one of the options. The second option, and that is backed up by the fact that this is a rising wedge from the low. Now these break down, these are not necessarily bearish. They're 70% bearish, but what people often forget is that means that they break up 30% of the time. So you actually see quite a few of them break up. or break down on falling wedges. So this one may well break up, and if we run this IHS scenario, then chances are it is going to break up, and that is our main scenario. But the alternate scenario is this is a rising wedge, that this breaks down, in which case this high here looks significant, and it's a match with this high here. This would be left shoulder. We'd just finished the head, and we'd be about to put in the right shoulder, which should have an ideal low in this particular instance of 1180. And in the event that we went through and broke this rising wedge support at 1275 and actually sustained that break, I'd be looking at that pretty seriously, because that is the number 2 pattern scenario here, and it would produce a better quality IHS. But the reality is, the first option is more likely because it's a better fit with the cycle dates. And when you have competing scenarios, and there are always alternate scenarios. So, one thing that a lot of TA newbies complain about is that you never get a definite answer. Of course you don't get a definite answer. There are no definite answers in the world around you.
It's all probability.
It's all probability. And it's all risk. You take a risk when you get out of bed in the morning. You take a risk when you don't get out of bed in the morning. It's the only way to avoid any risk of dying tomorrow is to die today. So that is just the nature of life. There are always alternate scenarios. You're just looking at the higher probability options rather than the lower probability options. And what makes this the higher probability option here is in large part the cycles and the high windows and the low windows.
Yeah.
Which are a better match with this scenario than with the larger IHS scenario. Yeah. All right. Great. Just wanted to share that.
I want to just emphasize what Jack said, which is I think the reason I use timing cycles is it really helps me when I'm in one of those 50-50 situations to say, like, for example, recently we were in a 50-50 situation with the E-mini, and I'm like, look, the high window says we go higher through the 15th, so we go higher, right? And so that really helps you where your lean might be. Now, is it right all the time? No, it's not. And you have to learn which ones are better setups from other ones, and that just takes time and experience. I have a couple of questions here, Jack. Hurst cycles have target prices, or is it a tool for time cycle? Okay, Sebastian, Hurst cycles, they have a, well, first of all, Hurst has a 900 and some odd page book. It's on my bookshelf. It's all mathematical, and the cycles do change based on what happens with price. And I'll say this about Hurst cycles, okay? When there's volatility in the market, Hurst cycles really work well. When you have a triangle or a sideways market, Hurst cycles are the worst thing in the world to use, okay? And in terms of it being used for price, the tool I just showed you, which is called Sentient Trader, it has built into it like price prediction stuff, but it is so poor, I don't use it. My TA is far, far, far better than what they have built into Sentient Trader. So, I use it strictly for time, because all Sentient Trader is it's using multiple cycle brackets and it's lining it all up, and it's using mathematical equations to actually equalize them, and so on and so forth. So, that just saves me a whole ton of time. Okay, that's the only reason why I use it, because it's expedient. It really is. How do you decide where to put the beginning of the cycles? Tomas, the Hurst cycles decide that for me, but on the other method I showed you, the box method, you have to determine which high to low swing you're going to use. Okay, so, and I'm going to show you fibs in a moment, which you use high to high cycles, high to low cycles, and low to low cycles, which I'll show you that in a second. Throw back the screen, Jack. I got a question here on the S&P.
One thing just to notice as well is that one thing when you're using historical data, and obviously all TA is using historical data. All data, by definition, pretty much is historical data. So it's when you're using historical data, you do actually know which were the highs and the lows in the past. Obviously, that is history, and that is the history of price you're looking at. So when you're looking at, you can look at the past performance of the cycles just by matching them up with price data.
Mm-hmm. Absolutely. And you see, you can do cycles without using Hurst at all. I mean, I just showed you how to use the box method, right? I'll show you on the Dow in a moment how you could use the box method and determine where the high is going to happen, the coming high. Now, here's the Dow, okay? And what we said last night in our analysis is that we hit a certain fib, the 1.618, which is a flat target. Okay, we hit it perfectly at 67.75 on the mini, and we said from there higher prices. Okay, so and that's what we've gotten today. Now we've been looking at a high window that starts roughly speaking on or around the 14th. You can see right there that is the 14th of August. Now the larger cycle, of course, is more inaccurate, and it goes all the way until the end of the month. But there's a smaller cycle here that I'm paying a lot of attention to, which is the 18th through the 22nd. Okay, so that's a period of time I'm going to be very interested in, and I've been talking about this on the daily update. The front part of this cycle, the 14th through the 22nd, is a window that I'm really paying attention to. I'm expecting a high window, and then if you notice, let me scrunch this in just a wee bit. Whoops. You can see from this significant, look at how many cycles were here. Okay, 1, 2, 3, 4, 5, 6, 7, 8, 9 cycles. Okay, the green cycle, the low for the green cycle is in November, but it'll probably be pulled forward into October. So I'm looking at a significant low in or around mid-October. Okay, and so I think this is the high before we see that low. Okay, and so that's what the Dow is saying. Now the other thing I do is I say, okay, that's what the Dow is saying. What's NQ saying? Well, look at this. We have a high window here right on the 22nd. What about the E-mini? Well, how about that? Look at this. We got another high window from the 17th until the 26th. Isn't that a coincidence? Oh, let's take a look at the Russell just to make sure. Well, look at this. We got another high window. What is it? From the 25th until the 17th. So, you know, if I go across instruments and I see high windows and they're lined up like that, guys, around instruments that typically correlate, I put high window on my chart. Okay, so that's why if you go to the S&P 500, let's just go to the S&P 500 real quick. On my chart, I have a high window marked on my hourly chart. I mark, you know, a wide box showing the length of the high window and where the high window falls. Let's see the S&P here. Hold on a second. This is where the Jeopardy song gets to play in the background. We have to find that tape. So here it is. Okay, so from the 14th, and I have it marked I have it marked all the way back until the end of the month, but the center date is the 22nd. So, you know, that's the high window, and look what happened right off of our 618 target, which is what we picked as a first target. We're bouncing, and we'll see what happens with that. So that's the answer. Somebody asked a question about, can you show for the S&P 500 of Hurst cycles? I just did. Okay, can you show how to do fib timing on the S&P? Yeah, I'm going to show Apple actually on fibs in a second. Is there enough to just choose a significant low or high and from there build them? Yes, obviously that's how you do it. So, you know, looking at the S&P here, I would say this was a fairly significant high, right? So, you know, you build your box method on this. So you have a significant high, significant low, right? And you look for patterns in the market, and all you do, and I did this already, I won't belabor it, guys, but, you know, here's a significant high, here's a significant low. Okay, here's your 3 waves back, and you pull it forward, and you say the A should be equal to the C in time. And it isn't always, but this is just one very basic tool to consider using. Okay, if you have a discrepancy between price cycle and time cycle, Elliot, which one do you rely on more? Sebastian, I don't rely on either. That tells me there's greater risk in the trade. Okay, so, you know, if like, for example, in bonds, the example in bonds, you know, Jack was saying longer term, we have a trend line. My stuff was saying we have 100% fib. My cycles were saying we got a high, you know, blah, 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 blah. Everything was saying that was the high. So everything lined up. And when everything lines up in trading, you have a low risk trade. Okay. Now, if you have a situation where your box method and your Pitchfork is saying something different than your Elliott timing, or I'm sorry, your Fibonacci timing, which is different than your Hurst timing, you got a high risk trade. Things are not lining up, and when things don't line up, you don't make the trade. Okay, I think one of the biggest issues with traders is you feel like you have to trade, and you don't have to trade. You have to really wait for the setup. Wait for the low risk setup. I think that is what I try to do most. Most of my time is spent waiting for the right setup. Okay, we waited forever for bonds to set up, and it was a great trade. Again, any comments?
Yeah, I absolutely couldn't agree more. You know, if you feel that you're not working unless you've got trades on, then it's a really expensive way of passing the time. You've got to find the setups that work, and you've got to wait for them, and you've got to trade them when they're there. But otherwise, if they're not there, don't create it. Because if you're creating a setup or trying to find something where there isn't something, then you're, by definition, setting up a bad trade.
Okay, Ken, you have a statement here. Senia Trader shows a huge correlation January 2016 low. And I think, okay, is that a reference date, or did all the cycles really sync that close? Ken, what you have to do with Senia Trader and any other system is it's mechanical, okay? And unfortunately, how can I say this? The market is not a mechanical system. It's a live, breathing thing, in my opinion, okay? So you have to take Senia Trader and adjust it. Like, you know, this low here, I could take this high here, for example. I could take this and move it to there if I wanted to, okay, just like that. And, you know, I could say pin the 54-month cycle to that low, and it would actually go and do that, okay? So you have to actually decide where the cycle low is, okay, and where the cycle high is. And sometimes, you know, you get a news event and it accelerates a cycle, okay? And so you got to pay attention to that. And so, you know, is this the significant low, and is this the 54-month low? That's a big question mark in my mind. I'm not convinced quite yet. You see what I just did? I just moved the entire set of cycles and I pinned it to that low, which accelerates this low, which accelerates this low, okay? And by the way, look what just happened. It just moved the entire timing out into November for this low, and it changed our high cycle as well. So, you know, I'm gonna try to ignore this. Let's see if I can remember how to unpin this. Well, I'll unpin it later, but basically you have to go around and actually adapt the cycles to how you see the market, because you cannot count on a mechanical system to have the intelligence that you do as a trader, okay? Okay, with that said, let's take a look at one other tool. So I've shown you the Pitchfork, I've shown you Hurst, I've shown you a very simple box method used in a three-wave move, an ABC, okay? Let's take a look at Apple, and let's look at Fibonacci's, okay? Now, Fibonacci's, I use them and I don't use them. I love them and I hate them. I don't know quite how to say it any other way, because they work and they don't work, okay? And so what some people do is they look at fib convergence, okay? Fib convergence is a very important thing when you're looking at symmetry in a market, okay? So, for example, I could use Fibonacci high to low swings, and let me just show you how I would do that. So here's a high to low swing, the A, swinging down to the low of W, okay? Now what I do on my chart is I mark usually the 50% move, the 618 move, the 100% move, the 1.618 move, and the 200% move. And what I typically do is I use multiple Fibonacci's. I'll do this, a high to low swing, okay, and then I'll do a high to high swing like this one here, high to high swing, okay, oops, wait a minute, it didn't work. Let me just grab the right tool. Okay, high to high swing, okay? And then I look for fib correlation. So you can see right here I have a correlation here. I have very little correlation between that. And all I would do is keep building this. So I would continue to build this out. So there's a high to high swing. I would do another high to high swing. Let's just do another one. Okay, high to high swing. Let's see what correlation I have. And I would continue building on the high to high swings. And by the way, I would continue building this out until I get fib convergence is way out here. So we have a 618 out here. Let's just keep going with this. So we have a high to low swing here, a high to high swing here, a high to high swing here. Let's do another high to high swing from here. Let's do a high to low swing three-wave move, an A, B, C down to the W. So another, let's see, let me just do it again. Hold on a second. And what happens eventually, you do enough of these. First of all, it takes practice to get good at this, like it takes practice to get good at anything. And what you typically begin to notice is after you start building this up and building this up, like here's a low to high swing, and here's a high to high swing that I haven't done yet. And I can already see from having done this that it's going to work out. Okay, see, we're starting to get some correlation here. It's not lining up here. We have something lining up here. Let's do a low to high swing here. For example, let's do another one. Here's a low to high swing. Okay, you can see there's an area here that's starting to correlate. Here's another area that's starting to correlate. We have a 200% here, which is one of my favorite targets, by the way. When the 200s start lining up, that is actually very meaningful. Okay, so and let's do another high to high swing from here to here. I don't know that I've done that one yet. So you can see what this is about. This is about actually lining up Fibonacci's and doing high to high swings, low to low swings, and high to low swings. Okay, and actually lining up your fibs, and actually then actually eliminating the fibs that don't matter. So you'd go back here, and of course you can see how this lined up here pretty well. Okay, so you go back and you delete the lines that don't really apply to your specific TA that you're specifically looking at. This was a nice X here in terms of how it lined up. Hold on a second, let me try to delete all these. So I think you get the idea. You clean up your chart. I would have a fib convergence here for a high swing. Okay, I would have another fib convergence here actually coming. And I would have more work to do here, guys, okay? But there's a high swing here. There's probably maybe a high or low swing here. And by the way, the reason I don't use this very often, only when I have really no clue, the other tools that I have give me no clue, this takes quite a bit of work to do. This takes quite a bit of work to do to actually use Fibonacci's, use Fibonacci timing, and to actually lay out all the high to high swings, all the low to low swings, and all the all the high to low and low to high swings. Okay, laying all these out on a chart, looking for fib convergence and looking for symmetry. It takes time to do it. And when you're doing 30 instruments, which is what we do on this service every week, okay, you can't do this on 30 instruments. Okay, you can do this only on certain instruments that you're tracking, or you can do this on a daily chart or on a weekly chart and look at longer term stuff. But certainly on an hourly chart, you're not going to have the time to do this. But that's basically the basics of how I would do Fibonacci's on a cycle basis. Okay. And that's really it for Fibonacci cycles and how I use them. Let's see if we have any questions remaining. Okay, any other questions remaining? I'm going to give people just a few minutes, Jack, to ask questions. Do you know of any other platforms for Hurst cycles? You know, you can do Hurst cycles yourself. You don't need a platform. The only reason I use Sentient Trader is it's not very expensive and it works, you know, for timing. I don't use any of the other price tools that are built into it. It has a trading system built into it that isn't as reliable as let's put it this way, I wouldn't trade using it. So Sebastian, I think you can do Hurst cycles on your own. Hurst has a book. You can get the book and you can create a spreadsheet and do your own Hurst cycles. It's not hard. Jack, any other questions on any other comments you want to make on timing?
No, not really.
Okay. The only other comment I want to make on timing is that we've talked about you know, daily, hourly, 4-hour charts and using cycles, using Hurst cycles, using basic TA techniques, even using Fibonacci's. The thing I want to say is this: there's also timing that works on a day trading basis. Okay, and there are certain times of the day that are high windows and low windows, etc. So you know, even if you're a day trader, okay, timing is an important consideration in your trading. Okay, and so you know, the thing I love about trading is there's always something new to learn, always a new arrow that you can put into your quiver. So, you know, if this webinar does anything, hopefully it gets you curious to explore more and to go and learn more, because, you know, every single day is a day for you to discover something new and add to your bag of tricks, okay, which will help you hopefully become more profitable and avoid higher risk trades and hopefully find low risk trades that make you money. I think that's the idea. So with that said, have you ever tried using Gann analysis as a timing tool? Yes, I have. And to be honest with you, it was so long ago, I don't remember how to use it at all. Okay. So Hurst analysis, Tomas, I use this tool, Sentient Trader. Okay. And while I'm here, let me just show you a couple of charts which are pretty interesting. And I'll just do this just for 30 seconds, Jack. Energies. Okay. Anybody want to wonder why I'm so bullish NG right now? Low window. Look at where the NG chart is pointing. Okay. What about oil? Let's take a look at oil. Okay. Low window. Anybody wonder why I'm so bullish oil right now? Okay. So, you know, this is a great tool to have in your arsenal. It really is. And I'm not trying to sell Sentient Trader. All I'm trying to tell you is if you see, hey, I think there's a low here, and then you see a chart like this showing 4 cycles, which I use 20-week through 20-day, and they're all pointing up, okay, that tells you something, okay? It gives you a clue. And a clue like this helps you lean to the right side of the market. And I think, you know, being on the right side of the market is everything, guys. Okay.
Yep.
So that said, guys, I think we're done. Jack, you have anything else?
Nope. I think I covered it nicely.
Okay. 1 minute chart or 5 minute chart, is it reliable? I don't use it there, but they have a version of it that works there, and that's something you might want to look into. I do not use time. I use other tools on a day trading basis. I don't use Hurst on a day trading basis, but they have a tool that they say works, which I've never seen, which I've never used.
I mean, the 1 and 5 minute charts I actually use all the time, and I find very reliable. But I don't use timing cycles.
Yeah.
So intraday, I don't think timing cycles are really the tool.
Yep, I agree. So I think that's a wrap, Jack. Thank you very much, and everybody, thank you for your questions. I'll get this up and posted on the site.
Pleasure as always, mate.
All right, thank you.
Thanks.
Take care. Bye-bye.